السلام عليكم ورحمة الله وبركاته. Dear students at Faculty of Commerce English section. This is section 3 of our interesting topic, Advanced Macroeconomics. And today we will have the concepts of GDP and how to calculate it, and how to have the function of production and Cap Douglas. And first, we will talk about GDP, and GDP is the gross domestic product, and this is abbreviation for gross domestic product. And there are many important measures used to assess the performance of an economy at the macroeconomic level over time. Some of the most important measures, this is gross domestic product, and the gross domestic product has its own components, and how we can measure the growth rate of GDP, price level and inflation rate, and the unemployment rate. First, we will talk about GDP. GDP is a standard measure of economic activity for a country during a given time period. It's defined as the value of aggregate production of final goods and services in a country during a given year. And this concept we have here, final goods, not intermediate goods. And what's the difference between intermediate goods and final goods? Final goods is for final user. It's ready to use by the final user, but intermediate goods are used by firms to produce the final goods. So intermediate goods are components of final goods and services, so that we take final goods and services in GDP because it's include intermediate goods and all the process of production in a country given a time period, and we have specific time period for goods and for calculating the value of aggregate production of final goods and services. The notion of value that is used in the computation of GDP is market prices. So we use market prices, a market prices by the national currency. So we must use national currency to compute the GDP. That is, all quantities of goods and services are converted into dollar term. Dollar term if the national currency is in dollar, and we know that dollars can used like a global currency, so we can measure GDP in dollars, but we must use market prices, and those dollar terms are summed up to yield nominal GDP. So there is a difference between nominal GDP and no and real GDP. So we have nominal GDP and real. Nominal is calculating GDP for the same year, but real GDP, in real GDP, we use what? We use base year for comparison. Why we use base year? To eliminate the effects of inflation. So we can measure the real growth rate of GDP, the real growth rate of GDP. Then we take the three approaches to calculate GDP, and we know there is expenditure approach, income or factor payments approach, and the production or value added approach. So we have three approaches in calculating the GDP. Most common one is expenditure approach, and this expenditure approach is the most straightforward approach to computing GDP, and it's often the most useful approach for macroeconomic analysis. And this method relies on the basic national income identity. So we here have GDP equal C plus I plus G plus net exports. And we here use net exports, although it's a GDP, because we consider it as exports minus imports as expenditure on foreign sector goods. So net exports is the difference between exports and imports, the other variable which appear in the national income identity. And net exports can equal 0, or larger than positive or negative. So net exports is 0 when exports are equal to imports. So we are at the equilibrium point and there is no deficit, there is no surplus. It's exports equals imports. And it could be positive, and it could be positive if exports is larger than imports. And it could be negative if exports are less than imports. So this is the important cases of net exports, and net exports could be 0, positive, or negative. Then we have every symbol of this equation. We know that C plus I plus G plus net exports. We talk first C, and T is meant by aggregate consumption. I is aggregate investment, and this investment not the investment of buying stock or buying bonds and all of this stuff, but it has a transaction like reservation for purchase by firms for capital. So purchasing capital by firms like machines, buildings, and all of these capital goods, and purchase of household of some durable goods that like housing and durable goods is meant by السلع المعمرة. So durable goods are goods that can be used on a long term. And we have G. G is the total government spending, including federal and local governments. And we have government expenditure and the government spending on buying goods and services from the goods market. And we have the second method of calculating GDP. It's income factor of payments. As we know before, we have four factors of production, and we have for labor, we pay rent, we pay wages. For land, we pay rent. For capital, we pay interest. And for the last factor of production, entrepreneurship, we pay profit. So we have four factors of production, and we have the income approach of them. Income approach, we use these incomes to also paying for goods and services produced in a country in a given year. So when we calculate GDP by income approach, we asking a very important question for all goods and services produced in the economy during a given year. What incomes resulted from production of particular good or services? The categories of income that result from production are wages, interest, rents, and profit. We summed up over all goods and services produced. The resultant figure in the GDP is all wages payment plus all interest payment plus all rents plus all economic profit. Of course, when we calculate GDP by expenditure approach, it must equal GDP by income approach. We have some statistical discrepancy, and it's like a small error. That's the difference between the two methods, but we have like equally. We then take the production value added approach, and this is a value added by a firm as its revenue from selling a product minus the amount paid for goods and services purchased from other firms. And by this method, we compute the value added approach equals wages paid plus interest paid plus rent paid plus profits earned summation is the sales or revenue of a firm minus its purchase from other firms. So GDP equals the sum of all value added by firms. GDP is equal to the summation of all value added by firms. We then take GDP as a measure of standard of living. A standard measure of countries is a standard living is GDP per person or GDP per capita. As mentioned above, GDP measures only those transactions coordinated through markets in poorer countries where poorer is measured by GDP. A higher percentage of economic activity occurs outside organized market than in richer countries. So we have a higher percentage of economic activity and this economic activity outside organized market and it's meant by underground economy. We have here underground economy. So GDP doesn't take in account other non-market sources of utility such as health, leisure, and these are the limitation of GDP because these are measures of living or standard of living, but it's not considered as a part of GDP like health, insurance, leisure time, and political freedom. And leisure time is considered as leisure time is opportunity cost for working time. Many studies have tried to incorporate these other factors, more complete measures of economic activity well-being, but not surprisingly, it's very difficult to quantify the dollar value of this non-market activity. We then measure the economic growth, and the economic growth is measured by the growth of per capita GDP over time. So the growth of GDP or GDP per capita over time is considered as economic growth. Economic growth can be taught as the expansion over the country's PPF. And we will take the draw of PPF. When we talk the draw of PPF, we know that PPF is considered as choosing between two goods. So if we say that we have military goods and we have here consumer consumer goods and we have a trade-off between military goods and consumer goods. This considered as the PPF. Expansion of PPF is considered as economic growth. So we here have economic growth, we have expansion in the PPF, we have shifting. So this is considered as economic growth. Economists generally believe that there are three preconditions for economic growth: markets, property rights, and the monetary exchange. We have three preconditions for economic growth: markets and property rights, monetary exchange. We then have the gross accounting using aggregate production function. when we use aggregate production function, we can say that we have gross. And how we can calculate it? We calculate gross by using a general function. General function is y, where is y is output, and we have a function where is there is two elements on it. K is the capital stock and N is the size of population. We we will have GDP or increasing GDP. GDP is considered when we have increasing in capital stock or we have increasing population, we have increasing in output and we have increasing GDP. The production function abstracts away from other inputs of production such as land. However, it has desirable feature and it's relatively easy to work with mathematically and it's a approximate actual production function, estimating using macroeconomic in many countries not too badly. So when we calculate it, we have solo gross accounting and we have Cobb-Douglas accounting or Cobb-Douglas production function, and these two functions can calculate the aggregate production, and from it we can calculate the total gross rate of output. Two features of Cobb-Douglas production function: displays constant return to scale, displays constant we then take Cobb-Douglas production function, and this is how to display constant return to scale. Simply put, this feature says it's if all inputs are scaled by factor k, then total output is scaled by factor k. Displays dimension marginal product, and we have dimension marginal product. If we remember the graph of production, and we have three cases. First, increasing production and then constant production and then increasing or first increasing production, then increasing at a decreasing rate, then constant, then negative marginal product. So this is by dimension marginal product. The total output generated by increasing the remaining input increases at a decreasing rate. This is when viewed as a function of only one of the inputs. And this is the graph of Cobb-Douglas. So this is a production graph. And then we have productivity and productivity. When we have gross and productivity, this is due to labor productivity and its output per hour worked in the economy. So we have increasing labor productivity. This means that we have labor productivity or output increasing per hour for one person. Business cycle. When we say about business cycle, we have first here we have what? We have here peak, and here we have the bottom business cycle, and we have expansion and recession. So this is the business cycle, and this is the growth rate of real GDP. That was section 3. If we have any questions, we can put it in the comments below. Thanks for your attention.